In this podcast episode, Arthur Hayes delves into the complex and multifaceted challenges facing the global economy, monetary policy, and society at large. The discussion spans from the consequences of relentless money printing, rising inflation, and debt to the transformative but disruptive impact of artificial intelligence, AI, and robotics. Hayes addresses the socio-political implications of economic stratification, the future role of banks and stablecoins, international geopolitical tensions, especially regarding China and the United States, and the evolving investment landscape marked by uncertainty and rapid technological change. Arthur Hayes articulates that the core issue permeating today's economy is perpetual money printing, driven by fractional reserve banking and Keynesian economic policies aimed at maintaining demand through government spending. This cycle encourages excessive credit expansion and eventual fiscal rescues of failing actors, resulting in mounting inflation that steadily erodes the average person's purchasing power. A significant symptom of this phenomenon is the aging demographic of first-time homebuyers in the United States, shifting from mid-20s in the mid-20th century to around 40 today, symbolizing broader economic stagnation and wealth inequality. Hayes highlights the polarization of wealth caused by inflationary policies that disproportionately benefit asset owners, noting that a mere 10% of Americans hold 93% of assets. This disparity fuels societal disillusionment and economic bifurcation, often characterized as the K-shaped recovery, where a small elite prospers while the majority face increasing struggles. A key barrier to resolving these issues is the political impossibility of genuine austerity measures. Hayes emphasizes that no politician can afford to enact policies that visibly contract credit or raise taxes, as such positions are electorally toxic. Instead, governments resort to constant money printing and distribution of stimulus checks to placate voters, which further entrenches inflation and economic fragility. The analogy of a parent giving a hungover teenager vodka to ease symptoms rather than treating the root cause encapsulates the political reluctance to confront structural fiscal problems. This short-term relief inevitably leads to worsened conditions, making eventual reckoning unavoidable but politically unpalatable. Both democratic and autocratic regimes exhibit this tendency, limiting meaningful reform. Hayes foresees AI and robotics as the next transformative force that will exacerbate economic and social fractures. While AI promises unprecedented productivity and near-zero labor costs, it threatens significant job losses, especially among well-paid professionals such as bankers, lawyers, and accountants whose roles are highly formulaic and easily automated. This rapid displacement raises profound questions about the future of work, income distribution, and social cohesion. The concentration of AI-owned assets in the hands of a few tech giants could deepen inequality, leaving large swaths of the population economically irrelevant. Hayes warns of an impending crisis of purpose and identity for many workers, alongside increased reliance on government support, potentially intensifying political tensions and societal fragmentation during the transition to a post-scarcity economy. Current market conditions are characterized by high volatility, as evidenced by sharp fluctuations in cryptocurrencies, stocks, and excitement around AI stocks that some consider bubble-like. Hayes notes that while AI-driven automation will improve efficiencies, it also introduces systemic vulnerabilities due to over-leverage and speculative behavior fueled by financialization. People's behavioral response to economic stress often manifests as hyper-gambling, engaging in risky bets on crypto, meme stocks, or speculative ventures, which compounds systemic risk. Government stimulus and easy money policies have also supercharged this tendency by placing free funds into the hands of underemployed or financially stressed individuals, leading to a volatile and unstable investment environment. Hayes offers a cautionary perspective on leverage, emphasizing that it is a tool best reserved for dedicated professional traders who understand its intricacies and risks. Casual or part-time traders who leverage their positions without deep market knowledge are prone to liquidation and significant losses, especially during sudden market turbulence triggered by structural changes or policy shifts. He explains complex phenomena such as automatic deleveraging, which can unexpectedly close profitable positions to cover losses elsewhere in the system, illustrating why comprehensive understanding and risk management are essential. The overarching advice is that most retail investors avoid leverage and focus on long-term, steady investment approaches using compound interest as their ally. Discussing the role of political leadership, Hayes is skeptical of any genuine fiscal responsibility emerging from either major party in the United States. He highlights that all presidents historically obtain the monetary policy they desire, reflecting the underlying political pressure on central banks to accommodate government spending. Regarding Donald Trump, Hayes views him as a non-ideological pragmatist intent on maintaining easy money policies to stimulate asset prices, especially in housing, consistent with prior administrations. Trump's ability to influence the Federal Reserve is not unprecedented. Presidents have long shaped monetary policy indirectly or directly. Hayes predicts that by the mid-2020s, Trump will assert greater influence over the Fed in pursuit of continued low interest rates and asset inflation. With expansive money printing and stimulus expected to continue, Hayes forecasts asset inflation across the board: stocks, real estate, gold, and cryptocurrencies, making it imperative for investors to position themselves accordingly. He advises buying and holding assets that historically outperform during inflationary periods, particularly Bitcoin, which he considers the fastest horse due to its fixed supply and resistance to debasement. Hayes dissuades attempts at short-term market timing or active day trading, especially against institutional AI-powered players, advocating instead for long-term, patient investment grounded in understanding macro liquidity trends. The lesson is to be wary of hype cycles and bubbles, exemplified by the inevitable bust following the current AI infrastructure investment boom. Hayes draws parallels between the current AI capital expenditure surge and previous historical expansions like the railroad build-out in early 20th century America. While AI infrastructure investments promise transformative productivity, they share characteristics of capital-intensive monopolistic industries with questionable near-term returns for investors. He warns of a looming correction similar to past tech busts, where overvalued hyperscaler stocks and AI developers might suffer steep declines before the true value of AI applications can emerge. Investors who enter too early risk significant losses, whereas patient investors may benefit from the post-crash opportunities when practical and profitable AI solutions become widely adopted. Looking ahead, Hayes anticipates stablecoins becoming integral to the financial ecosystem, potentially supplanting traditional banks in many transactional roles. He points out that government and financial institutions recognize the strategic value in stablecoins, particularly as a vehicle to distribute treasury debt globally in a highly efficient digital native format. The rise of fintech platforms and digital wallets augmented with AI assistance will accelerate user adoption, especially among younger generations comfortable with smartphone-based financial services. Traditional banks face existential challenges unless they adapt rapidly to this digital-first environment, where decentralization and ease of use are paramount. The discussion turns to international tensions, focusing on the relative decline of U.S. global hegemony and China's ascent. Hayes emphasizes that history shows declining powers rarely accept diminished status without conflict, raising the specter of geopolitical instability, particularly around Taiwan and South America. However, he also offers a measured perspective, noting China's demographic challenges, technological ambitions, and growing robotics ecosystem as both a strength and a societal balancing act. The Chinese government's prioritization of AI and robotic automation over traditional employment aligns with their vision of a techno-authoritarian future, offering stability but also potentially intense social strain. Hayes contrasts this with Japan's robot-focused approach to demographic decline and little appetite for immigration, suggesting different cultural responses to labor shortages and economic challenges. Europe presents its own unique challenges, chiefly the structural flaws of the Euro currency union, comprising diverse countries with differing economic needs and political priorities. Hayes views the euro as an unsustainable arrangement that centralizes monetary policy at the expense of fiscal autonomy, particularly straining countries like France. The deteriorating financial imbalances within the Eurozone and the potential for capital controls re-emerging threaten the stability of the currency bloc. Hayes advocates caution for investors holding European assets and suggests repositioning wealth outside of Europe in anticipation of increased fragmentation or austerity measures. Despite an often dire analysis, Hayes maintains a grounded outlook anchored in historical perspective. He underscores that the cyclical crises of debt, money printing, empire decline, and technological transition have occurred repeatedly throughout human history, from ancient Rome to the post-World War II order. Recognizing the patterns of financial and political upheaval provides a roadmap for resilience, emphasizing owning assets resistant to confiscation or debasement, such as gold or Bitcoin, avoiding leverage, and maintaining patience to benefit from compounding over time. This approach tempers alarmism with pragmatism shaped by centuries of precedent. Throughout the conversation, Hayes stresses the importance of individuals adopting responsible financial habits and political awareness. He criticizes passive acceptance of inflationary policies backed by political elites of all stripes and calls for greater political activism to challenge entrenched fiscal irresponsibility. However, he also expresses skepticism about the feasibility of real change given the incentives of politicians to seek power through handouts rather than tough reforms. The result is a grim but honest appraisal that enduring improvement may only come after substantial social or economic pain, reinforcing the need for individual preparation. Hayes's personal investment strategy revolves around recognizing inevitable monetary expansion and positioning in broad assets that appreciate under such conditions. He eschews stock picking in favor of exposure to Bitcoin due to its digital scarcity and resilience against inflation. Hayes views AI equities and infrastructure as fraught with timing risk and unlikely to produce consistent returns in the Hall of Fame style without careful market cycle awareness. He encourages investors to avoid leverage, engage with financial markets with a long-term horizon, and maintain situational awareness of global monetary policies and liquidity trends as the principal determinants of asset performance. His conviction in Bitcoin as a store of value reflects broader themes of monetary debasement and technological transformation pervasive in the episode.